Hello and welcome to a brand new show of Market Makers. Union budget is done and dusted. The market reaction looks positive. Sometimes no news is good news. Even though the budget was a very pedestrian budget, both in terms of approach and construction, I guess markets are breathing a sigh of relief that the event risk is behind us. But what the budget has done to kickstart the economy, revive consumption, and kindle the broken down investment cycle. And from a market standpoint, how should one really read into Union Budget 2017? To discuss all that and much more, I have with me a very special guest. I've always maintained that he's one of the smartest stock pickers on Dalal Street, Akash Prakash of Amansa. Akash, what a delight to have you back on ET Now. Thank you for joining us. What is your understanding of Union Budget 2017? What do you think was the wow moment according to you?
No, I think the wow moment was just the lack of any damage, actually. In the sense, I think the markets were extremely nervous about the tone and tenure of the government's discussions and speeches before the budget, in the sense that they seemed to be a move that, almost like an anti-rich type of environment being created, that if you were wealthy, you had done something wrong and that's how you had got your wealth. I think that type of rhetoric they've backed down from. There's no change in capital gains, no estate duty, no wealth tax. I think maintaining of status quo and recognizing that it's not immoral to have wealth. I mean, you could have worked hard and got wealth legitimately. It's not all black money or not illegitimate. I think that's a refreshing change back to the tenure and rhetoric of 2 years ago. So I think the lack of damage, the doing nothing which will hurt, I think the animal spirits of investors and capitalists, I think that's the biggest positive in my view.
Akash, but some would argue that the world around us is changing and the world around us is expected to change a lot. These are not normal circumstances. So maybe this budget could have been that platform where some out-of-box thinking could have been done.
Yeah, it could be, but I think one is that this government has clearly, has done reform outside of the budget itself. That's one thing, number one. Number two, I think this is a transitional year in the sense that, he doesn't know GST is coming in this year. He doesn't know the revenue impact of GST. He's been conservative in budgeting that. You have the headwinds of oil prices up 50-60% from last year. You're coming off demonetization, economic growth numbers are not clear. How long will the economy take to fully recover is not clear. So I think this is a transitional year where frankly, I don't think there was that much room for him to do things. Could he have done more structural stuff, direct benefits transfers, you bring in a UBI and, cancel all subsidies. I mean, he could have done more transformational stuff. But my sense is you'll have to wait a year for that. If, as we expect, GST is genuinely revenue enhancing, I think there'll be a lot more space and scope to do things in the following budget, 2018, 2019, than what he's been able to do this year. I think this year, to be fair, they don't have much room, and there's a lot of ambiguity on many of the macro variables. I mean, you don't know growth, you don't know revenue. I mean, I think it would be unrealistic in my view to do anything very transformational this year, number one. And number two, also, I think it's not the nature of this government. This is not a finance minister who's going to break the box. I think he's more incremental in nature, which is also fine in the sense that, I think as I said before, I think it's actually quite a decent effort given the constraints that he had and given the, given the nature and what they can actually do. I think it's unfair to expect him to be transformational in this year and say, I mean, if you ask me what transformational idea they have, I would struggle to think of what they could do which would fundamentally change the outlook for India in the short term. I can't think of anything short term. There are a series of steps you need to do which are not in the budget. Administrative reform, judicial reform, police reform. These are much more longer term things not to be talked about in the budget, and things I hope they will move on in the period after the budget.
Akash, what really matters in the long term for an investor like you is that which way the earnings trajectory is moving. And irrespective of this budget, do you think there is a big question mark there? The economy is trying to recover from the demonetization impact. Your key sectors like IT and pharma, which were blossoming a couple of years ago, growth digit now will move from double digit to single digit. So whereas we may feel happy that budget has been a no event and no news is good news, we have a mountain to climb when it comes to earnings and global concerns.
Yeah, I agree with that. I think that's going to be a very stock-specific market this year because the reality is that post-demonetization is not very clear. I mean, in the sense that you have companies in the same industry giving you a very different commentary on their growth outlook. The organized sector seems to be gaining at the expense of the unorganized sector. The company's growth is dependent on rural-urban mix. So it's a very much a stock-specific environment right now. Company by company, the outlook can be quite different, even in the same industry. So I think it is a more complex market, and it's really a stock picker's environment because I don't think you can make broad sector calls right now. It really depends on the company, how it's positioned, what is its distribution system like, what is the rural-urban mix, what is the level of unorganized versus organized penetration, what's the impact of GST on them once you know what the rate of GST for that product is. There's so many company-specific variables you have to look at that I think it is not, I mean, I wouldn't make a broad sector call on anything, frankly, at the moment. I think you really have to look at every company specifically, look at their business mix, their raw material mix, their outlook on GST, etc., and make a stock-specific call. You can't make a broad brush statement at the moment, but I will agree that earnings is where the market will now have to refocus because the budget is past us. I think the scope for PE multiple expansion is limited. There may be some more limited amount left because interest rates are going down and look like they're structurally headed lower even from here. For at least a little bit more left there, juice left there. But earnings is stock specific, and we have to look at that literally a ball-to-ball commentary on that one.
So are you a bit surprised with the underlying price action? We are less than 4% away from an all-time high on Nifty in the month of December. If you would have argued and made a case for 9,000, I mean, it would have been more like a laughable scenario, but now it's like a realistic scenario. We are touching distance away from 9,000.
Yeah, I think two things there. One is liquidity. It's that the amount of money coming into domestic equity, both from mutual funds, insurance companies, is really quite significant. I think this thesis we've talked about in the past, Nikunj, that the thesis I've always had is that eventually in India, the domestic investor base will swamp foreigners in terms of the importance and driving the direction of the market. I think that thing is now starting to play out. Irrespective of the fact that we've had $6-7 billion of selling by foreigners in the last 2 months post demonetization, the Indian markets have actually gone up or have been stable. And that's entirely driven by domestic flows. I think domestic flows is structural. This is a break in the sense that I think the investor base domestically has been under allocated to equities for a very long period of time. I think with the weakness in real estate, gold, and other alternative assets, I think there's very limited alternative where people can go with interest rates now down to 5-6% in bank deposits and stuff like that. So I think this move, a wave of money into domestic equity is we're still in the early stages of that. So I think liquidity is what is keeping the market where it is. It's what's driving it up. I don't see any change to that short term. I think on the foreign investor side, it really depends on the flow to EM, Trump, so many other things. But I think foreign flows will be mediocre in my view this year. I don't think you're going to see a huge chunk of money coming into EM unless you see weakness in the US, Trump doing more silly things, and the dollar weakening instead of strengthening, which is one scenario which could happen. But I think the Indian market is now driven by domestic flows and domestic investors. I think that is structural. I think we're in early stages of that cycle. Therefore, I'm not. I think that is what's driving the market short term. Nothing else really.
So, how would you map the market movement for next 2 or 3 years in the absence of very strong gangbuster earnings and with lot of liquidity? Are we likely to hit the pause button, or liquidity is like a rising tide, it will take all ships up?
I think liquidity, I think first is I do believe that earnings will have to come back, will come back. I mean, we've all been wrong on this in the sense that if you'd asked us 2 or 3 years ago, we would have expected that by now you would already see strong earnings traction. It hasn't happened. The profit share or GDP keeps dropping. It can't get much. I mean, in my opinion, at least it's already sub 4%. From a peak of 8. So I don't think that ratio gets dramatically lower from here. It'll be unlikely. There's no reason why profit share should structurally be at all-time lows forever. So I think that earnings will come. It may be 12, 18 months. I'm hesitant to give a guess, but given that interest rates are structurally lower, given that economy is still growing at 7, 8, whatever percent real GDP, earnings will eventually catch up. It's not going to be, if you take a 3-year view, I cannot imagine an environment where earnings will not be back to strong double digits, levels, 15, 20% at least, if not higher. So on a 3-year basis, strong domestic liquidity, which I think will continue. The fact that earnings will eventually have to come back, this profit share to GDP ratio can't keep declining. There's no reason why. So I think the picture for the markets on a 3-year basis is actually quite good. It's quite strong. I obviously, there's no precision to this. I can't tell you that earnings will come back next quarter or in the 6 months. I don't know. But if you take a 3-year view, as I said, it is my view, very, very high probability that you will get earnings growth back to 15, 20%. And that combined with the strong liquidity we expect domestically, I think will augur well for markets. Markets will do well over the next 3 years.
You've not liked PSU banks historically. You've always betted on private enterprise rather than public enterprise. Suddenly there is a lot of strength in PSU names, whether it's SBI or ONGC. We know that their balance sheets are getting better. If corporate India turns around, who knows, SBI and BOB can come out with great set of numbers. So are you aligning with the economic recovery? Are you now finding value in some of the public companies?
Well, we have always been aligned in the sense that if you look at our portfolio over the last couple of years, we have a very strong exposure to an economic recovery type of environment. Just again, not thematically, it's worked out that way. Public sector, I think it's specific in the sense that I do believe that there is a theme which is valid, that there's a desire to run them better under this government. There is hopefully more operational freedom being given. There is some signs of management change. Bank of Baroda is an example. I think the SBI chairwoman has obviously done a great job. These are two stocks which we've looked at. So, I have some sense there. So I think it's again, if I can get a PSU bank or any PSU company where I believe that the management has got some visible tenure and the management is smart and driven by the right incentives, then it is something we would look at. But again, I'm not prepared to make a blanket bet on PSUs or a blanket bet on PSU banks. I think again, it depends on who's running them, who's the management, what's the incentive, and what's the industry they're in. So no thematic on PSU banks, but would we look at one or two of them? Yes.
I think in 2014, when we had a conversation, you were the first fund which went zero on consumer staples. Is that call still on?
Yes. Yeah, it's on because I still don't understand the valuation, in the sense that I still feel that for the type of growth that they can deliver, I think the valuations are too expensive. They're obviously outstanding businesses. Massive free cash, ROE, ROICs are 60, 70, 80%. So I have no debate on the quality of the business. My point is that you're paying everything up front for the growth, and probably more than you should. That's my view. So I don't see a great IRR buying these stocks at 45, 50 multiple. That's a personal view I've had, which at times has been totally wrong because the valuations have keep going up. I still don't see the case for why I'll pay 50 times for some of these companies, but that's a view I've had. I think there are better alternatives available in the market today, which give you a better expected return profile as these consumer, better than these consumer staple stocks. So that's a view we've maintained and we continue to maintain. We'd love to buy if we could, but it depends on them getting cheaper.
In 2008, when the world was folding up, it was time of great financial crisis. I distinctly remember you went and bought into TCS aggressively because the business had become cheap. Are you getting similarities in IT now?
Yeah.
There is a belief that there is going to be a reboot in the IT sector, both in terms of the model and also in terms of the transition. And suddenly these good quality companies are trading in early double digits.
Yeah, no, I think IT is intriguing. We are trying to spend a lot of time on IT to figure out what to do, because we don't own much there right now. But because obviously the stocks are screening quite cheap. There's no debate. I think, and they're good businesses. Obviously, the debate is, that there is a structural transformation happening in IT, which it is, in the sense that the core legacy businesses are deflating 10 to 15% on a renewal, which is quite clear. And the Indian companies have much lower market shares in the new lines of business, digital, cloud, etc. than they do in the legacy. So there is a transition required where your core business is deflating and you don't have enough market share and growth in the new lines of business. So I think again you have to evaluate company by company, see which company will make the pivot, will make the turn, and be present and have adequate market shares in the new lines of business, and some won't. So I think we're going to spend time over the next 6 months trying to figure that out. That some companies will make the turn, some won't, and those which make the turn, hopefully the market will keep punishing all IT stocks in an indiscriminate fashion. So some will become cheaper than they should, and some will be rightly cheap because they won't be able to grow. So it comes down to figuring out which company will make the transition. There is clearly a transition happening in IT today. This is not the IT services of 5 years ago. The labor-based arbitrage advantage model is slowly decaying. You need to have market share in consulting, digital, cloud, automation, etc. Every Indian company will not make the transition. Some will do it well, some will not. You need to figure out which companies will make the transition. And if you can figure out that, and if you're confident that somebody can make the transition, then the valuations are getting interesting for those one or two companies which will. And I'll just end by saying that one or two companies will make a transition. I'm not sure which they are today, and we're still trying to figure that out, and it'll take us some time, hopefully, to figure that out. But it's clear to my mind that there will be one or two buying opportunities in this space over the next 6 months.
You've owned Lupin in the past. Now, Lupin is the only large cap pharma company which has managed to buck the trend. They've got approvals for all their plants. Are you hunting in that pharma space as well? There is a belief that nothing could go right for pharma. 3 years ago, there was a disbelief that nothing will go wrong.
I think pharma, in my mind, is 1 to 2 years, 1 year at least behind IT, in the sense that the valuation deflation has not happened to that extent in pharma as has happened in IT. In IT, you're seeing stocks trading at 12, 13, 14 times. Pharma is still 20, 25, 30 times, so they've not gotten anywhere near as cheap as IT. And on a free cash flow basis, even more stark the difference, because the free cash generation is far greater in IT than in pharma, number one. Number two, I think the regulatory challenges in pharma are still there. I mean, IT, of course, has its H1B, and we'll see what happens there. But that's still quantifiable. I think pharma, this whole FDA issue, the consolidation of buying power in the US, Trump is making statements on the pharma side as well. So I think there's still some way to go in pharma. And also the thing that bothers me in pharma is if you look at the valuations, Mylan and Teva may be a bad example because they just lost the Copaxone patent, so its valuation may be affected partly by that. But Teva and Mylan, the number 1 and number 2 player in generic pharma globally, trade at 10 times earnings. And it's not that they're bad businesses. They have 30% operating margins, they have decent ROICs, and good cash flow, but they still trade at 10 times. I mean, Mylan's market cap is less than $20 billion. It's or $22, $23 billion. It was less than Sun's market cap. So I think you need to figure out also that what is can an Indian generic pharma company have a $30-40 billion market cap if the largest generic pharma company in the world has $35 billion market cap? So, and of course, the EV and all that. So, Teva and Fallon both have debt. So, it's not entirely market cap. You got to look at EV as well. But I'm just giving you a sense that, we need to understand what is the potential for overall market cap creation in India if the world's leading generic players have market caps and P multiples which are really quite low. So again, we're doing more work on pharma, but I think it's not anywhere near as cheap as IT. So I would prioritize IT over pharma in terms of the work that we're doing right now.
Interest rates, Akash, are low. They're likely to come down more. Cost of borrowing is going to come down. The rural economy is going to recover. So one should focus on consumer discretionary. You bought iShare in the past, something which has worked like a charm for you. Anything in the consumer discretionary space which is there on your radar?
Well, we have a very large holding in Maruti, which we've owned for 5-6 years now. So which is, but it's unfortunately a consensus buy. Everybody owns it, so there's not much value I'm adding by saying that. No, I mean consumer discretionary. We have significant exposure in autos. Maruti, we have iShare, we've had Ashok Leyland for 4-5 years now. So I mean those stocks remain. We haven't really sold any of that stuff. We do believe that sector will continue doing well. There's nothing specific there. I mean, we haven't changed our portfolio there. It is what it is.
Your body language is telling me that you're delighted with what Federal Bank of late has started. I know it's been a painful position for you, but finally numbers are coming out. They're coming out of the turf. Do you think the bank, or in this case, the franchise, have they rediscovered their mojo?
I think so. I mean, I talked about Federal Bank at the Sohn conference. I mean, my entire presentation was Federal Bank. The stock was, I think, 43 or 44 or something at that point in time. The stock obviously done well. I think there's significant upside from here as well. I think there is genuine change there. They've rediscovered their mojo. They're much more confident. Good management team, good additions to management, much more aggressive, good capital adequacy. I think it's well positioned. I think the bank will do very well.
Just to wrap up today's discussion with, with one of the articles, I'm sure when there was confusion and chaos on the triple taxation issue, that must have given you sleepless nights. Some clarity has come in yesterday's budget.
Yes, I wrote an article on that.
Yes, some clarity has also come on on yesterday's budget. But as a foreign investor who runs a boutique business, the India Dedicated Fund, are you now satisfied, happy, and more than satisfied and happy, are you now clear on what the law is going to be?
Yes, again, I haven't seen the fine print, so that's the only caveat. But as per what the finance minister announced in the budget, it was unambiguous, it was clear. I think all dedicated India dedicated funds, boutiques like us, are in the clear. Again, assuming there's no fine print, I haven't read the explanatory memorandum. I'm assuming there's no fine print, but he was very clear that FPIs category 1, category 2 FPIs will be kept out of the indirect transfer provisions, which covers almost all funds as far as I know. So I think that's unambiguous and clear. And I'm thankful to the finance minister and the government for listening. We all made representations. I'm happy that the government realized that this was unintended collateral damage, the initial circular. So I would like to thank the government for listening and clarifying this. And as of right now, assuming there's nothing in the fine print, it is clear, unambiguous, and I think it's business as usual for all of us, thankfully.
But before I thank you, I'm tempted to ask you one more question. I'm taking the liberty of extending my appointment. Like I said, you rarely talk to us. So my final question would be, what is your short-term market outlook, which is 6 months? What is your medium-term market outlook, which is about 2 to 3 years? And what is your long-term market outlook, 5 years and beyond?
In short term, frankly, Nikunj, I have very limited capability to forecast. So I would say, market around, maybe it goes to a new high, and then sticks around there for some time, maybe up or down 5-10%. I frankly, next 6 months, I don't really have much of a view. I think there'll be chaos around GST implementation, this, that. So I would say the market will tread water here, plus minus 10% from where we are today over the next 6 months. I think it will be more a holding pattern till we digest GST and understand these things and the rules and stuff like that. So I'm not wildly excited on the next 6 months. I'm not wildly excited. On a 3 to 5 year basis, I genuinely believe that this will be a very attractive market. Strong domestic flows, earnings will come in eventually. Interest rates are low and will remain low. And I personally feel that emerging markets will come back over the next 3 years. So you'll have a triple whammy, right? You'll have strong emerging market flows, which will help India. You'll have strong domestic flows, which I think is at early stages of that cycle. You'll have earnings kicking in because we're coming off 7-8 years now of almost no earnings growth. And as I said, profit share to GDP has hit rock bottom. It cannot go much lower. And nominal GDP is still growing double digits. So you will have 15-20% earnings growth. So I think the environment is there for very strong market performance over the next 3 to 5 years. I think investors should remain invested and just fill it and forget it and look at this after 5 years. I think they'll have very strong returns. 6 months, I said 6 months, I'm not wildly excited. I think it's a trading pattern, 5-10% plus or minus from here. But 3 to 5 years, I think it's a very, very attractive market and opportunity.
But we are very excited that we had you on the show today. So appreciate your time and glad you could accommodate this interview request.
Always a pleasure. Thanks, Arvind. Thank you.
Well, that's it on this edition of Market Makers. Doesn't get bigger than this when you have Akash Prakash, market veteran, someone who has very sharp, deep and profound understanding of Indian markets and how earnings and how the macro pieces would move. Thanks for tuning in and thank you for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.